Hey everyone, I wanted to drop this quick message for you all simply because I've been asked this question a few times lately and wanted to address it with you all. The question is, Marcus, how is the stock market moving up when the economy is doing so crappy? And so the disparity between market performance and the economy has been top of mind for investors these days. And it seems odd to most people that there can be 21 million people unemployed. An unemployment rate of over 15%, by the way, is the most severe since we've seen since the Great Depression. However, back in April, the S&P 500 had its best month since 1987. So what do I mean by that? The market is up 28% from its bottom on March 23rd. The question is, did you experience those gains or did you panic and jump out? So with all the doom and gloom and the sky is falling rhetoric that spews from the media each and every day, by the way, as I record this, year to date, the S&P 500 is only down a little over 8%. And so solid market performance in the face of a weak economy has led to a lot of questions, perhaps a little disbelief about where this market optimism is coming from. It is equally important to examine the factors driving markets higher. So, first and foremost, there's been unprecedented monetary and fiscal policy responses, which have clearly had a positive impact on market psychology and calmed the severe volatility of February and early March. Remember this too. The Fed slashed interest rates and the government pumped in over $2.2 trillion of stimulus, all which has been to support the markets. So here's something to think about. We are only in the early innings of this economic cycle, and markets may be latching on to some optimism since some of the states are now starting to reopen. Meanwhile, the economy is in an apparent free fall. So what do we have? Deep job losses will likely lead to sluggish spending throughout the year. And as the recession evolves, investors will likely look for increased diversification and they will have a reduced tolerance for all this volatility. And for investors, the recession will likely have a bigger psychological impact, and that could continue for months and months. Think about this. The day-to-day uncertainty of seeing friends, neighbors, families, people become unemployed or perhaps even lose their business on top of the continued health crisis will increase the desire to limit those losses and reduce the tolerance for people being in the market. So here's the deal. The economic ramifications of the coronavirus is out there and it's just beginning to unfold. Now, should the pandemic last longer or should a surge of new cases cause another round of shutdowns, markets could react with fresh volatility. Who knows? Now, the Fed will probably continue to be active with policies that try to pull us away from the cliff of a financial crisis. But please remember this. The very human desire to jump out and then try to time the market should not overshadow the long-run investment goals of diversification and income, which could become even more important during the economic challenges that lie ahead. And so if you don't have a plan for income, a plan for diversification, or a plan for taxes, click the link below to schedule a 15-minute call with me to find out if we can help. I'll find out where you are, we'll find out where you need to go, and if we can help, we'll develop a plan to get you there.